Our next guest still finding upside in a number of sectors that hit new highs just today. Top wealth advisor Cheryl Young of the Rockefeller Global Family Office is back at Post Nights. Good to see you.
Thank you, Scott.
All right, so you were positive on the market before many. So here we are. We're in the midst of what's been an incredible move. Now what?
Well, that is the question. We're kicking off the quarter today, so it's an exciting day to join you, Scott. Look, we're starting to see some broadening. You look at the equal index, for example, the last month, it's up 3.5. S&P is up only 2.8. So we're finally starting to see this broadening you and I spoke about in January take hold, and I'm optimistic that'll continue, but concerned about some sectors, maybe some overbought areas.
Okay, so why do you think the broadening is going to continue, first of all? Well,
first of all, there's more trades than one stock. The number one performer in terms of the S&P 500 is 25% of the returns, 25% from one name. What
would that be, NVIDIA?
I can't talk individual names.
Okay,
we were concerned last year, as you know, that 32% of the returns came from 7 stocks, and that was horrific. So I would just like to think there's other places to invest. I kind of think it like going to Vegas. When you see a table in Vegas, and I'm not a Vegas girl, but if you see a table that's crowded, you start seeing more and more people crowd around. We call it a hot hands fallacy in behavioral heuristics. It's concerning. So we want to see some broadening, and the markets can broaden and should broaden from here.
I think it was either the last time that we spoke or perhaps the time prior where you were starting to get a little bit nervous about valuations on mega cap. I remember the conversation that we had. So if that was you then,
yes.
Where are you now?
So in January, I started selling calls on a lot of these names in the Magnificent Seven, 10% out of the money. Now, some of those names are in the money, and I'm going to be really happy if I get the 14% I have remaining in terms of the call income for the year. 14% I'll take all day long. I don't see how this market goes up 14% from here, especially on the mega cap tax.
Do you think we've gone up too far too fast overall, or does this just make sense to you? We're expecting rate cuts. The economy's strong. There are many reasons, bulls would say, to be bullish.
Yeah, and I think it's a good reminder to have a pause. First of all, we are still expecting rate cuts, but there are some questions around how many. I know in January you were saying 6, and I was like 2, maybe none. I'm still saying 2, 3, maybe none this year. I think it'll happen, but the data is good. Look at the PMI numbers this morning.
Well, that's one of the reasons why yields went up and stocks got a little skittish for a moment.
Anything above 50 signals expansion. And so when we have data coming in this strong, the job numbers are good, the industrials are good. I just don't see how the Fed cuts rates in June.
Is that a problem if there are no cuts this year, or is it, why are you shaking your head? Yeah, so that still matters more than the strong economy. Well, some would say, well, the economy's this good, we don't need rate cuts.
I would argue the stock market started rallying in December when the Fed appeared more accommodating.
Oh, well, there's no doubt, right? The pivot sort of set this whole thing off.
So the pivot set this tone. So if that doesn't happen, I would have to believe the stock market has some cooling off to do.
Even if the economy is stronger now than it was then, or at least we thought it was, right? Part of the belief was, well, the economy's got to cool off, so we're going to need rate cuts. In addition to the fact that inflation's coming down, they're going to be able to cut for the right reasons.
Well, and remember, not all of the stock market has participated. Last year, it was technology and nothing else. Year to date, we have seen other sectors start to lead ahead of technology, which is what we talked about in January when I was here about some of this pivots into some other sectors.
Like energy, which was great last month.
Number one, industrials, materials, I still really like financials, and I still like healthcare. We have not seen as big of a rally. And some of these sectors, energy is still behind where it was 3 years ago. So there's a lot of catch up to do. So again, I would say look at the market in terms of not necessarily broad indexes, but which sectors can work, what's going to work well with the AI trade and support the AI trade. Again, energy has to be energy. It's the biggest bottleneck when we think about AI expansion. And we have an election this year, which really probably could benefit, sectors like industrial.
I mean, you have to be reasonably broadly bullish if you like all of those sectors. I mean, that's almost the whole market.
Well,
right. If you like tech a little bit less, but you still like it.
But I don't like real estate, for example. Not keen on that area, and that's worked out well for me. I've had no exposure, thank goodness.
Right. All right, but that's one, right? I mean, you like energy. You're adding more to utilities, as you said, industrials, materials, financials, and healthcare.
But I'm trimming technology, which, by the way, the first time I've ever appeared on your show was the last 2 times where I've said I'm trimming technology. And 5 of the Magnificent 7, as you are very well aware, since I was on the show last time, have underperformed the S&P. So I think that can continue. I'm not excited about hardware right now. I hate to say it. I like some areas in technology. I like AI still, but be careful. Maybe add a little. We've talked about my rock climbing.
Right.
You know, as I climb up the wall, I like to add just a little bit more protection into walls and make sure if I take a fall, it's a small fall, not a big whipper fall. I want to continue to think about using options because I don't want to create taxes. Remember, I'm not just a portfolio manager. I'm a wealth manager. If I sell all of these magnificent names in my portfolio, I'm going to crush my clients in taxes. So can I hedge them with some options and creating some ability to keep those names? Maybe there's some upside, but if there's not, I'm going to get 12 to 14% income on the options. I'm okay with that right now from here on out for the rest of the year, frankly.